Zach Mefford is here from Zip Bonds, and he's going to be the one leading our webinar today. So thank you so much, Zach, for joining us and for giving of your time.
Yeah, thank you for having me. I'm excited for this.
Um, Go ahead, take it away.
Yeah.
You have the ability to share your screen, right?
Yeah, are we
Perfect.
not sharing already?
Yeah, no, it went away when
There you go. When I jumped off.
yeah.
Okay.
hmm and tell everybody a little bit about yourself and how you ended up at Zip Bonds
Yeah.
creating
So
that.
let me get this going here.
We
All
can
right.
see
You
it.
see,
Yep.
see that okay?
Yep.
All right. So yes, thank you for having me. Zach Mefford here with Zip Bonds. We're a full service surety brokerage. We operate as a managing general underwriter, which means we have underwriting authority in house. We work with multiple carriers, and mostly we work with a lot of insurance agents all across the country, helping them place some of those surety bonds that they either don't have a market for or just might not have any markets for surety or don't want to be subject matter experts. So a little bit about my background, just over 10 years in the insurance industry, the space. Started off my career at State Farm, thought I was going to be Zach and khakis, and quickly realized that I very much enjoyed the commercial insurance side of things. So I transitioned to become a commercial insurance producer, where I was fortunate enough to be a top producer for a local agency that was owned by a carrier. And quickly, the entrepreneurial spirit kicked in, and decided that it was time for me to go out on my own. So in 2016, I started a independent insurance agency with my then co-founder Ryan. Created a really great book of business that was not only commercially focused, but also we very much had a emphasis on creating good technology. So through that process, we created a platform that worked with credit unions. It's still up and running to this day. But after partnering with the fourth largest credit union in Iowa and creating this tech stack, we developed a business to a point where they wanted to buy it. So we sold that off, and that's how I got to Zip. The reason why I'm in Surety is, as a person who prides himself on being a bit of an insurance nerd, I feel as though I was able to do almost everything for my clients. And I typically worked on the commercial side with contractors, both as a producer and as an agency owner, and found that surety was one of those things that was very confusing, and I didn't quite understand why it was so much more difficult than some of the other lines of businesses that I was writing. And so it was one of those things that kind of always, stuck in the back of my mind as something I thought could be done better. So fast forward through 2020 as COVID hit and got a little bit bored, and we'd already learned a lot through the tech stack we developed for the insurance agency side. And knowing that we were going into selling it, I wanted a new challenge. So that's the genesis of how Zip was created and started. And we officially launched in June of 2021. 3 full years now into it, and growing rapidly. But again, the whole idea of the why behind it was, wanting to create a better solution that I couldn't find for myself as an insurance agent who was not a subject matter expert in surety. So I put together this presentation as a way to hopefully start with basically, your surety 101 all the way through a case example of how we've helped some of our clients go from not having any surety options all the way up to getting to a point where they're bidding the largest jobs that they want to bid. So I'll start there. I put together this presentation, should be 25-ish minutes just going through the content. And then I've left it open at the end for questions because I very much want this to be interactive. And so again, you're free to interrupt me at any time. I can't see everybody now with the way this is set up with the slideshow. So if there are questions, please feel free to interrupt me at any point so we can answer these questions. Um,
I'll definitely let you know if there's any in
Great.
the chat. Yeah.
Thank you. All right, so let's get started. Today, we talk about surety bonds, specifically contract surety. There, we categorize surety in basically three different funnels, if you will. We have contract surety, which is your contractors that need primarily what we focus on is bid bonds, performance bond, payment bonds. We'll get into that. But there's also the commercial aspect. This is typically your smaller license and permit bonds that contractors may also need. So this whole presentation is geared towards contractors, but specifically towards the contract side. And then there's also a court fidelity type of funnel, if you will, that we're not going to get into today, but I'd be happy to go into more detail if anyone has questions on that after the presentation. All right, let's go start with Surety 101. Whenever I talk about surety, especially since surety is typically sold through an insurance agent, I like to first start with the differences between surety bonds and insurance. So at the core of what it is, the easiest way I can explain it is even though insurance does regulate surety and it's typically sold through an insurance agent, the quicker I can get everybody to shift their mindset to the fact that the underwriting on a surety bond is more tied to a financial product. Think of like a line of credit as an example of what we're trying to do. This should help you understand why we have to ask for certain things that are different than insurance. This will help you understand why the underwriting is more selective. This will help you understand why it's so much different than insurance, because at the end of the day, surety is not insurance. So what are the differences? You know, insurance, two-party contract. It's, you know, we're taking the probability of there being a loss, expecting there to be a loss, and then underwriting to trying to get to an underwriting profit. So in insurance, we expect losses to happen. We're hoping just to cover most of those and have some profit at the end. That's how insurance has been built up, or is the way that it's designed to work. When you think about it, it's a risk transfer. You're transferring it from the insured to the carrier. In that process, those losses are not recoverable, meaning you have a claim, you file it, it gets paid out. They're not going to go after the contractor in this case for those losses. Carrier's not going to come after them. It's just they took on the risk, and it is what it is. Because of that, and because insurance expects there to be losses, there's more broad underwriting, meaning it's rare that you wouldn't be able to find some sort of a solution, even in the most unique situation where you couldn't find an insurance product to cover a certain type of risk. You know, your primary carriers are going to work through most of the, the more common things like your general liability, commercial auto, and the marine, workers' compensation, what have you. But some of the more complicated things that we run into, cyber has been a big deal right now. You know, I ran into a lot of different higher limits of pollution types of accounts. You know, those are somewhat harder to place, but if you work with a good broker, it shouldn't be difficult to find an option when needed. Again, this is why you want to work with an independent agent who has multiple options, because as we get into this, you're going to see that just like insurance, surety does have its nuances of different types of underwriting, which is why you want to be able to work with somebody who has the capability of accessing multiple markets. So the difference between insurance and surety, the most obvious one, instead of a two-party contract, it's a three-party contract, which is held between the principal, the obligee, and the surety. So instead of transferring the risk from the insured to the carrier in this situation is acting more like a co-signer, saying, yes, we've underwritten and vetted this contractor. We believe that they are capable of performing the project to its completion. We think that they have the capacity to do it. They are well funded. They're not going to have any issue doing it. And then when we get into the next slide, I'll talk a little bit more about the character of the underwriting process that surety goes through. Again, going back to my analogy of a financial product underwriting, just like with a line of credit or any type of loan, the surety bond company isn't expecting any losses. Surety is underwritten to a 0% loss ratio. The idea in a perfect world is they would never have a loss. And that's why you see the direct loss ratio be significantly lower in surety as compared to insurance. It does happen, but it just doesn't happen as much. And we can get into more of that if there's any questions about it. But at the end of the day, this is very much underwritten like a financial product, not an insurance product. And that's probably one of the biggest differences. I think the next most big difference you would see would be the fact that the losses are recoverable, meaning if there is a claim against a contractor in a surety contract, those losses are ultimately still held by the contractor, and the surety will try to recoup in most situations any loss that happens. This is why every surety bond that's underwritten is going to require a general indemnity agreement. And so what you're basically signing is saying, just like you would typically maybe guaranteeing a lease on your office space or guaranteeing a loan, you're basically saying if there is an issue or a problem or a default in any way, shape, or form, I know that I'm still personally responsible for that. And sureties, will go after the contractor if there is a loss. Because of that, surety bonds are much more selectively underwritten, meaning that it's not as broad of an appetite. There are no's in this space. At the end of the day, surety's trying to underwrite this like a financial product, and there's certain situations that just don't make sense. It's rare that we will run into a situation where we can't find at least some path to an option. But at the end of the day, there are certain situations that just don't make sense. And as I like to explain it to any of the agents that we work with, is typically when that happens, you're kind of protecting the contractor from themselves, or helping them help prevent them from getting into a situation where they're likely going to have an issue. which at the end of the day is what we all want. So that when you look at surety, the way that it's underwritten, they call it the 3 C's of surety: character, capital, and capacity. So character is, what kind of person is this? What kind of contractor they have? What's their track record? Is this someone who has experience in this field? How long have they experienced in this field? Is this somebody that is an expert? Is somebody that knows what they're doing, is going to be able to, if taking on a project, going to be able to complete it and isn't just winging it and trying to figure out what they're doing as they go. Another part of character is just looking at credit history. You're going to see that I listed those both in character and capital because it's such an important component of the way that surety bonds are underwritten. Again, given that it's a financial product, the credit history and credits reports are very much a good indicator of whether or not a contractor is going to default or make good on any contract that he puts together. Because of that, one of the things that we commonly will run into, good, bad, or indifferent, is past bankruptcies. Some carriers will look at a past bankruptcy and say,
what's the last name?
oh,
Ferguson.
somebody's on. So yeah, bankruptcy is something that we unfortunately run into every now and then. And because of that, the reason why is some carriers will look at it and say, if you've had a bankruptcy at any point, we just don't ever want to underwrite that contractor, because we believe that if they've filed bankruptcy once, they will file it again if something bad happens and they just need an easy out. On the flip side, we have some very good contract or very good carriers that look at it as, what's the situation? What caused the bankruptcy? Was it something that was a one-off deal? Did they get caught up in a financial crisis? Was there a bad, divorce that caused this? Is there something that's a good reason why? And then we'll look at that a little bit differently. Again, that's why it's so important to have multiple options, because carriers will look at it, some carriers will look at it one way and some will look at it another way. Another part of character is, past legal issues. When they underwrite the contractor and the company, they are underwriting the company, but they're also underwriting the owners that are in there. If there are people that have a checkered past, if you will, that would make it more difficult for that person to likely get the best options or any option at all when it comes to a surety wanting to write those bonds for them. In the capital, again, credit history is super important. We want to make that something that is an emphasis and a focus. And as I get into our example later on in this presentation, you'll see why that continued to be an important factor in helping a contractor go from, a very small amount of bond capacity to as large as they wanted to. But we're also going to look at the company. We're going to look at the company's financials. Are they taking good? Do they have good accounting practices in place? And so again, using my example of a financial underwriting, it's kind of like if you're going to get a mortgage, they want to make sure that if you tell them that this is how much money you're making, this is what your W-2 shows, that it actually matches what you put on the application. That's where your financials are going to come into place. If you say you're a profitable company, but you're not doing anything on the accounting side to reflect that, it's going to be really hard to have any proof of it. And we're going to get into that a little bit more of how you can find a better way of providing the best case for your application. But the company financials are really important. And I know it may not be a surprise to some, but it can be sometimes to us, of how many people don't have even just the basic, like QuickBooks type of accounting system set up. Again, going back to who we're underwriting, yes, we're underwriting the company, but we're also underwriting the owners. And this can be a little bit complex, especially if, say, there's more than one owner, and one owner has really great credit and has a really great history of making payments, but then you have another that doesn't quite, match that other owner's level of credit worthiness. There's going to be some complexity there in trying to figure out, okay, company looks good, one owner is good, but what about this other person? Could that potentially cause an issue down the road? Is it something where it's an indicator that if they've defaulted or had issues with bankruptcy in the past, is that going to be a concern if something gets tough, working through a project? So owner financials, company financials are both very important, and it's something that, like I said, I'll get into a little bit more, but we want to make sure that those are being tracked and updated on a frequent basis. Going back to capital, assets, net worth, certain carriers are going to care almost exclusively, if not just a lot more, about somebody's personal assets, personal net worth. It's going to be super important to them that they have that, and the other things aren't nearly as important to them. Other carriers are going to say, we really don't care if there's net worth or there's a large amount of assets to the owner. We just want to make sure that there's good cash flow and there's a good amount of capital built up into the business, and that's how we're going to underwrite. It's two different methods. They both work, but again, it's carrier specific. Some put more of an emphasis on one and some put it on the other. Capacity is another issue. This is going to go to, okay, look, we understand that you have the experience. We understand that you're a good credit risk, but you just started a job. The largest job you completed maybe is 500,000, and now you want to bid a job that's 5 million. Okay, well, are you able to take on that size of a project? I think being an entrepreneur myself, I can understand that sometimes people want to bite off more than they can chew because they believe in themselves and they think, well, we'll figure it out as we go. It's not a big deal. It's the same type of stuff. It's just a much bigger project. And while I can appreciate that, the idea that we need to help our clients and these contractors understand is just because you think it and you're confident in doing it doesn't mean that there's not a track record of insurance carriers and surety carriers having dealt with somebody that bites off more than they can chew and realize, oh, I didn't realize that they weren't going to pay me for 180 days. Or sometimes we see up to 300 days where someone gets paid. Do they have the cash flow to make sure that everybody still gets paid along the way? And they're not going to run out of business in the process because they took on something too big. Another thing that we run into is we will have people that'll bid jobs and they might, the project might be, 3, 4, sometimes 10 times the size. And they think to themselves, well, if I get this project, then I'll be able to hire more people and I'll be able to get that piece of equipment that I need to help make this easier to complete. Well, as we all know, if you run into some sort of issues like we did during COVID, where the supply chain really messed up the ability for people to get access to certain pieces of equipment, certain materials, an underwriter and a surety company is going to look at that. Do they have the people in place right away? Do they have the equipment now? So if in a worst case scenario, like we saw with COVID happens, that they're going to be able to still perform the contract to its completion. They're going to be able to do it on time, and they're still going to be able to get access to the materials that they need to be able to complete the project. Another constraint that comes up is geographic area. And one of the best examples I can use for this is we have some commercial roofing contractors basically say, I don't care where it's at in the United States. I'm just going to go, like wherever I'm needed and wherever the work is, that's where we're going to send our teams. Well, in theory, that makes sense. In reality, sometimes that can create some complexities. You're going to have teams that might not want to travel all the time. So you might have personnel issues. More common, I think we see some suppliers that they expect to have in place that'll run things the same way that they saw in their normal or more local geographic area. That it's just a different type of setup. They might not have lead times might be longer. They might have access to the same materials. And so those are one of the things that the surety is going to look at and say, okay, how long have you done this? Do you have the expertise? But also, if you're traveling all around, have you thought through this? Have you thought through how you're going to get your teams there? Have you thought through what that cost is going to look like? Have you thought through all your suppliers? Is there anything about that you maybe should consider that you haven't going into it? And that's, again, where we have to come in as the professionals and the trusted advisors and help them understand why they're asking these questions, and knowing that at the end of the day, all we're trying to do is make sure that they don't potentially put themselves in a position where they haven't thought of something and run into an issue. So if you're going through surety, you're going to say the application process looks different than insurance. And this is where we get a lot of our questions is, why do you need that information? Why do you need my spouse's information? Why do you need my social? Why are you making my spouse sign for something that's not here? Let's just walk through what a typical process looks like. So first and foremost, you're going to get a contractor questionnaire. It's very similar to an initial application you would for any type of insurance product. It's called a questionnaire typically versus an application, but at the end of the day, it's the same thing. You just need the basic information: business name, what state are you incorporated in, what type of business entity setup do you have, who are the owners, what are the percentages of ownership. And we'd also like to see, at a high level, potentially just get some basic, information from the financials. Like, what's your gross income look like? What's your net income look like? When you look at the past surety, have you had any experience with surety? Have you, what's that carrier look like? What was your bond capacity? These are just really basic information that we need, and it helps us be able to find, okay, what's the best option? Where should we start? And what additional information might we need? This is going to be required on any new submission. And although there are some things we're going to talk about here with some more quick issue credit-based applications, having something filled out into its entirety and the more information you provide just helps your agent put yourself in a better position to have multiple options. The worst thing you could do in this situation is not provide all of that information, because you never know what's going to help you and what's not. And if you don't put in all the information accurately, it goes back to character. Meaning, if you say you didn't have a bankruptcy, well, they're going to find out anyway. So you might as well put it on there, because they're going to pull that and find it. And if they know that you were misleading them from the beginning, that could be a quick, no, we're not going to work with somebody who's going to, essentially mislead themselves on an application. Personal financial statements. Again, like I said, some carriers care more about the assets and the net worth of the individual owners more so than they do about the business financials. So it's always nice to be able to provide this. Yes, you want to have it for each individual business owner. When we help agents place business, we provide a template for that. Most carriers don't care which way it comes in. They just want to know, like, what's your personal, financials, like what are your assets, what are your liabilities, how does that all shake out, what does your personal net worth look like. And for some of these smaller contracts, if you only need $1 million or less capacity, it's not going to be necessarily always required. It's always nice to have, but a lot of these carriers are now getting to more of just a credit base. And basically, if you are in the state, you're not going out of state, or you're not going too far away from your local geographical area, you have the experience and your credit's good, that's usually all they need. Anything though, $1 million is usually where we draw that line. We're just going to require it at that point, because there's no way for us to do the best job we can do and provide multiple options unless we have this. And it's such an easy thing to fill out. It's just really nice to have. And as you start to grow, if you want to grow from where your current capacity is to a higher amount of capacity, it's just a good habit to get into, to keep updating, because it helps tell a story. When we're talking to our underwriters, we're trying to put together a submission with a nice summary that helps them understand, like, this is who they are, this experience, look at this track record, any type of track record of filling these things out and having a consistent process really helps us explain and sell ultimately that contractor to the carrier. Business financials, really important for us to get the profit and loss and balance sheet. If it's under $1 million, something simple like in-house, just pulling QuickBooks, just a P&L and a balance sheet is a good starting point. Again, if it's under $1 million, it's not maybe always going to be required, but it's always nice to have to help find the best options. And if you get over that $1 million mark, it's just going to be something that's absolutely required. And moving forward, going on to the next part here, having good accounting for having a good CPA that's putting these together on a quarterly basis, and explaining in a way that's audited by somebody else, or at least reviewed by somebody else, really helps find the best option. So it's not just my internals. I'm not just making these numbers up. We've had a third party look at it. We have a third party that knows that these are accurate and are attesting to the fact that they are. And so having a CPA that does that for you and provides that written summary and explanation of saying, hey, a third party looked at it and it's right, we're good. Again, going back to that financial underwriting, if I go in to get a mortgage and I say, yeah, I make this much money, here's my homemade budget on an Excel sheet. Well, that doesn't really mean anything. But if you provide W-2s, if you provide tax returns, and you provide something that's more concrete, that allows the underwriter to get more comfortable with saying, okay, what they're telling me is true. This all checks out. We can go ahead and move forward. You're going to see that with your accounting too, the accounts receivables and payables, this is going to be like your work in progress is going to be really important. The idea of having this WIP, as they call it, in place is saying, okay, if we have this capacity, let's say it's $1 million and they want to jump to $2 million, how many of these projects do they have going on what time? What's typical for them? What's the expected completion date? Because a lot of times contractors line up work, months, sometimes even a year out in advance. We need to know that they're going to be able to satisfy the requirements of those projects and move on to the next one. And so having a ongoing work in progress analysis is something that just helps us provide the best options. And it's just really a good habit to get into when trying to run your business, so you know where you're at. It's sometimes going to be a little bit of adjustment, but once you get into it, it's not that hard just to update these things. And lastly, personal and business bank statements are something that may be required. Again, this goes back to my mortgage analogy. We just want to be able, if you say you've got X amount of cash in the bank, we just want to be able to see that what you're saying is actually true. And so that may be required, especially when we get over that $1 million mark. And again, our recommendation would be, at least on a semi-annual, but preferably on a quarterly basis, just keep all these keep these on a consistent reporting method to be able to help put yourself in a position to increase your capacity. One thing that I didn't put a whole slide into because it can be kind of complicated. It is dependent on geographic area. It can be dependent on type of trade, years in business. There's so many nuances to it that I didn't want to I could do a whole seminar on that one. But the bond cost, typically, you're going to see your credit only types of bonds be written at a flat 3%, regardless of the amount and size. And as you start to get into a full bond capacity program, you'll start to see that rate goes down. Typically, it'll go from 3 to 2.5 or 2%, and then it'll be a sliding scale, meaning that maybe the first million of the project's at 2%, but from 1 million to 3 million, it's 1.5%. And then anything over that 3 million would be 1% or even lower, depending again on the size and the capacity that the contractor would qualify for. Some other things to consider. I take a lot of pride in the fact that our team always tries to work to get to a yes. And there are certain situations that can be a little bit difficult. These are ones where maybe the contractor probably should, by their experience level and their amount of capacity, be able to work on something that's larger, but they just don't have the financials or the, they maybe have something like a past bankruptcy or something that's caused them to have a little bit of issue getting to that level. So here's some of the things that we can do to potentially help take something that would be a typical no from a standard carrier and turn it into something that's a yes. The first one's going to be funds control. Carriers knowing that there's a third party that administers the payments from the obligee to the principal and has control over that, alleviates that concern that they might spend it on something else, or they might not manage that money well. And so funds control can be put in place to help somebody if they're taking on a large project, but it makes sense. They just want to make sure that the money's being handled the right way. We have multiple carriers that can help us put that together, but it's just one of those easiest options to be able to put this in place. There's a bit of an expense to that, typically around a point of additional premium that's going to be required. But if it helps you get to that next level, it's something we definitely want to consider. Another thing that we've been able to do successfully is help with co-signers. So just again, financial underwriting. If you don't quite qualify, but you have somebody that maybe has higher net worth, has some assets, that says, I believe in this contractor, I believe in what they're doing, I'm willing to put up my own personal assets on the line to show that that I believe in them, that we can get it done. We've been able to do that, whether it's a silent partner, sometimes it's a family member, or somebody that can just come in and help the financial case look a little bit better because they have the assets to back up the capacity that we're trying to get to. Typically through that co-signer, there's also going to be an option for collateral. Most often, the easiest option would be to have a revocable letter of credit, meaning that your bank's going to be able to say, hey, there's an amount of money that we're going to put off to the side for a fee, and that's going to be sitting there where the surety carrier can pull from it if there's ever an issue where something's not getting done. Either the contract doesn't get completed correctly, or a subcontractor or a supplier files a claim against it because they didn't get paid. That's the way that the surety will feel more comfortable that, hey, at least there's some money off to the side to pull from if we absolutely need to in a worst case scenario. Doesn't happen very often where that is pulled from, but again, it's just kind of trying to build a better financial case as to why a carrier might want to take on a contractor that doesn't check all the boxes that they normally would. And sometimes the collateral, cash, securities, we've seen those be used. Real estate can be done, I'd say, in our experience, using real estate as a way to secure that letter of credit is a more efficient way of getting it done, as opposed to just putting up the real estate, because real estate's not as liquid as having a letter of credit. So our recommendation typically is say, use that real estate as collateral to get the letter of credit from your bank, put that in place for the surety to be comfortable, and we can reassess where we're at and say, a year. Sometimes we'll do it on an annual basis. And if things take off really well, it might be less than a year, but that's typically what we see. Another option that we found is somebody says, let's say they have a capacity of up to $1 million and they want to bid a $3 million project. We go to them and say, hey, look, I understand what you want to do. I understand that there's things about this that make sense for you. It's a little bit larger than what we would typically get you approved for. Is it possible that the general contractor, whoever's in charge of the project, would be able to split that up in maybe 3 phases? So instead of doing $3 million all at once, we might say, okay, this first phase is, we're going to clearly identify what needs to be done and when it needs to be done by. And then once that's done, we essentially start a second $1 million and then a third $1 million contract to help get that done. That can take a little bit of, hand-holding and negotiating, but it is one of the more easy ways that, especially if collateral or co-signer is not an option, that we can try to help somebody jump, from say that 1 million to 3 million, or, triple the size of what they currently have for capacity. And that's something we definitely are able to help with and walk you through if that comes up. Last but not least, we are accredited with the SBA, and we can help use the SBA as an option. We typically try to use the other ones first, mostly because the lack of control that you have with the SBA. I mean, it's a government-run program. We're on their timeline. We're on their schedule, and they can just say no if they want to say no. But some of the things that we've really had a lot of success with is when none of these other options are available and someone's had a past bankruptcy, the SBA will consider it and will essentially co-sign for the contractor and the carrier to help secure that amount of capacity. So if something goes wrong, the SBA is going to take on, typically it's 80 or 90% of that risk. And then the contractor isn't going to be on the hook for as much. So Surety will be more comfortable having the SBA back it, knowing that if something happens, just like it would be on an SBA loan, that the SBA is going to handle it so they don't have to go after the contractor for everything. Another thing that we run into, over the 3 years that we've been in business here is just anybody who's non-U.S. citizen. The SBA does have options for that. A lot of carriers will not consider somebody who doesn't have a social security number. And the concern there is that they just don't have a way to go back and try to, come after them for whatever they may be out if a contract goes bad. The SBA looks at it a little bit different, especially with an I-10. They're going to pull that because you can still pull a credit indication with an I-10. They're going to look at that as somebody that they can back and get comfortable with, as long as the credit does still match their minimum requirements. So we use the SBA in those options, but otherwise, if possible, the other suggestions that I have here before is what we typically try to do first. So let's say we get you into a program. So typically almost everybody starts at a credit base only. We can underwrite those up to $1 million within a few minutes. It's a flat 3%. But you come to us and you say, hey, we love the fact that we have this $1 million, but we'd like to get to a point where we can do $5 million, $10 million, $20 million contracts. What do we got to do to try to increase our capacity and present our case better to these surety carriers? So there's a few different things that we can do. First of all, the business net worth. This is a big thing that we run into, especially when we're helping somebody from a smaller program get to a larger program, because I think most people are conditioned. I just want to run as many expenses through there so I don't show anything at the end of the year, so I can not have to pay any taxes. Well, again, going back to my financial underwriting suggestion, if you're trying to get a mortgage and you go to a bank and you say that you're self-employed and you show that you're not making anything and that the business is basically at a break even every single year, it's going to make it really tough to get a mortgage. It's the same idea of when it comes to surety underwriting. We want to be able to show the carriers that you are you're running a profitable business and you're retaining some of that profit to be able to help grow the business, which will allow your financial strength to be higher and allow you the capacity options to be broader. Working capital, improving your cash flow. Again, I think we sometimes run into these situations where contractors will just want to bid everything because they just want to win all the jobs. And at the end of the day, if they were running the math on what they're doing, they might be winning a lot of business, but the margins are so thin that they're really not making any money. And that could also be a red flag for a surety underwriter. So what can we do to help improve cash flow? Maybe we set a minimum on the percentage of profit that you want for each project. Maybe we try to find a way to be more efficient in how we're doing things. So instead of going, 200 miles out, maybe we just say we're going to do 150 or 100 miles, so we don't have to spend as much to win these projects and to complete them. The other thing would be just being really careful with how far you extend your credit. We run into this a lot with, if it's net 30 or net 60, you're paying 90, 120, 150 days out. Those get reported, and it can show that you're not paying as quickly as you should. And so by tightening those credit policies and allowing your suppliers, subcontractors to get paid more quickly on time, really helps build a case for why your business is able to sustain and grow in a way that helps increase your capacity. Similar to wanting to build up a little bit of that, net worth in the business. From the business side, you want to do the same thing on your personal net worth. I know, again, contractors that we have worked with don't want to build up everything in their business. They might have a spouse that works on it, and they try to show nothing for themselves, again, typically for tax reasons. But at the same time, it's not a bad idea to maybe just pay yourself what you're worth and pay yourself a fair wage. Start showing that you're building up those personal assets as well, because again, some carriers will take more of a stance that the personal net worth is more important than the company's. And we just want to make sure we're able to provide different options, and having both be a priority is something that can really help expand your options. Another thing that has come up, and I think this is probably one of the ones that doesn't get talked about as enough, but it can be really important, is carriers are going to look at what's your largest project ever completed. So if we have you at $1 million capacity and you want to do a $5 million project, if it's not something that you can get approved for a bonded job, even going out and doing a private job that doesn't require a bond, that might say $3 million, that helps us prove the case. Like, look, they got a private job, it wasn't bonded, but they were able to complete it. There was a success. Everything went well. They had good profit, and because of that that now helps show the surety that you are capable of taking on a larger project, and that alone can help us sometimes move the needle to a larger capacity from that. So I'm going to use the 1 million credit based and getting you into a actual bond program with better rates, higher capacity, and just overall help your business grow. Last but not least, something I think that once you get to a point where all the blocking and tackling, the simple things are taken care of, if you really want to step up your game, the contractors that go from that smaller capacity that really take a step up, they're going to start working with a really good CPA who's going to put together their financials. Typically, we'll do it on a quarterly basis. Sometimes it'll be semi-annual, but we're going to want to get those financials reviewed by somebody. We want a third party to sign off on those. And eventually, at a certain point in the capacity, you're going to want to get those audited. Make sure that somebody's going through and checking everything, not just a review, but an audit to say, what they say is right. Yes, they are growing. Yes, I'm signing off on this. That type of accreditation really makes the underwriters and these carriers feel a lot more comfortable when they present the case, because sometimes they have to run it up the chain as well too. Especially if you're trying to increase your program very quickly, that's something that people that really take it to the next level, they'll go ahead and do this. There is an expense to it, but it's an investment in my opinion, because if you're not able to get to that higher level and increase the capacity and get these larger jobs, in comparison, the amount that you're going to invest in this is so small that it really is. But you got to be at that level where you need to get to a higher capacity. And for most, just starting off with doing, like I said, the blocking and tackling, the simple stuff, doing your financials consistently, your WIPs your personal financials all consistently, doing those little things. Once you start to build a reputation with your agent and if they work with a broker, they're going to be able to help you understand when that time is to start adding this. And, that's something that I've taken a lot of pride in our team being able to do and helping. So with that, I'm going to give you an example. So here's a contractor that we ended up picking up late in 2022. They came to us and they said, hey, we want to start bidding some public work. We don't know a ton about it, but we found you guys. I think they found us on the SBA website and they wanted to start working with us. So when looking at the initial profile completely, they did have good credit. Both owners did. The prior experience was there, but they were a newer company and newer ownership structure. So there was nothing wrong with the fact that it was newer. It just sometimes that can be a bit of a hurdle, but they had the experience, just really helped. And they also had experience with a larger project than what they were initially, looking for capacity. However, they weren't consistently tracking their financials. They didn't have an accounting process in place. Nothing as simple as even QuickBooks. They were just, tracking it. I believe it was on an Excel spreadsheet. They just weren't doing a good job of keeping track of all those. So, if you don't know your numbers in your business, you don't really know your business, and that's one of the things we helped them understand. They didn't have a work in progress. They weren't working with the CPA. They weren't retaining anything in their business. They were just trying to, again, not pay as much taxes as possible, which again, I understand, but at the same time, their goal didn't really match with what they were trying to do. They needed to understand to get to that next level. We had to build a portfolio here of the business is growing and we're retaining some of it. So we are in a better financial position. And they also didn't have any personal financial statements. Regardless, we still, because the credit was really good, we were able to get them a $750,000 per project per aggregate program at a 3% flat rate, and that was it. There was nothing over. If it was $750,001, it wasn't going to happen. It was just, this is it. This is all you have. But it was a good start. And once we got them up and going, they said, look, we understand based off what you said, but we want to get to the next level. What do we need to do? So we put together a plan. Going into 23, credit was still something that they made sure was good, both for their business and for themselves personally. We had the prior experience. They incorporated an accounting software and started tracking their business financials in a way that was consistent with what underwriters wanted to see. They hired a CPA at that time to help them go through that process and make sure that things are being reported accurately. We started doing it on a quarterly basis because they very much wanted to increase that capacity as soon as possible. We helped them set up a work in progress and reporting, also done on a quarterly basis, put into place a financial statement for the owners and help them understand that, paying themselves at least something so they, closer to what they were worth. Wasn't quite all what they probably should, but they were at least putting something in there and showing like, hey, we're also building out our own personal net worth, not just the business. And then they put together a plan of making sure they're going after projects that were profitable and then retaining some of those profits so they could, again, start building the case of why the business would make sense to go to the next level. At that point too, what can also help is because we felt so strongly about this company and seeing that they were doing all the things that we were telling them to do and following the plan, that we wanted to try to expedite the process, even though not everything was in place. So we set a meeting. At that point, it was just a Zoom call with the underwriter and helped that underwriter see who they were, what they were doing, and let them tell them their story directly. And that's something that can be a really impactful thing on helping an underwriter get more comfortable. And usually it starts with just a video call, something like that. And then as you'll see in the next slide, once we really want to make a jump, sometimes it's a personal visit. We want to go to a job site. We want to talk through it. This is no different than some of these risk advisors that come in from the carrier side when they're looking at an initial application. They say, okay, I understand what you're saying. It makes all sense, but like, let's do a job site visit first and try to make sure that what you say is in place, and that we agree with those things. 2023, though, they were still not hitting the sales goals that they needed to hit. Their net income had dropped, but again, it was working through the things that they needed to do. They were paying themselves. They were making sure that they weren't just taking every project just to take every project. So the gross sales are down a little bit, and the cash flow was still a little bit negative, but it was trending in a good direction. And they were, again, a newer business. They had a lot of overhead and money that they were investing in doing that. So it wasn't a total red flag, but it was something that we really wanted to focus on. Taking them out of or pulling them out of that so they could get to a point where they could increase the capacity. Because at the time they were saying, look, we want to get to a point where we do 5 million, 10 million, 15. We want to build a long-term play here for our business, and we just want to keep stair-stepping it up. So we did take them from that credit only because of everything that we put together and got them into a standard program where they were allowed to bid up to $750,000 per project or $1 million in total capacity, meaning that they could do a $500,000 and two $200,000 jobs all at the same time because of that capacity. We kept them at a 3% flat rate because it was such a short period of time. When we got that approved, it was less than a year from when we started working with them. But we, again, said, keep working the process and the plan, and we'll get you to a point where it's, we'll get you out of the 3% flat rate. The other thing that we really got out of that was the project size was negotiable. Because the underwriter understood and had that meeting and felt comfortable, if they wanted to bid something that was a little bit over 750, maybe it was 800 or 900, it wasn't an immediate no. They wanted to talk through the project, understand why it was a good fit, and if it made sense, they were willing to make an exception, which I think, if I remember right, we actually did get one of those done in 23. Now, move forward 1 year yet, 2024, again, still focused on the credit, experiences there. Everything is provided on a quarterly basis for the financials, WIP, personal financials. The CPAs also put together a review of them, meaning a third party signing off on them. They increased the gross sales because they were being more intentional, the types of project they were going after. That also helped their net income increase. They started retaining profits in the business. They wanted to make a big jump, so we scheduled we flew in to meet with them to go over what they wanted to do, did a job site visit, talk through the whole thing, and then help them. It was specifically for this job that they wanted to go to, wanted to bid, sorry, that was a $3 million bid, and it made really, really good sense for them. But one of the things this contractor did that I applaud them for is they helped tell the story as to why it made sense. And then we presented that to the carrier when meeting with them in person. Because of that, we increased their program from that 750, 1 million. This is, again, just 1 year later. We have now approved to 3 million per project, 6 million aggregate. And that now it's at a 2.5% sliding scale, meaning the first, say it's the first million. I don't know the exact numbers off the top of my head, but the first million might be 2.5. Maybe 2 million to 3 million might be 2%. 3 million or more might be 1%, so on and so forth. Because of all of that work, and because they followed the process, they put in the work that was necessary for them to get to this level, they were able to bid that $3.1 million project, and they won it. But the thing that's really impactful for their business is not only did they get to grow into something bigger that made sense and where they want to go, because they put in that work, we were able to take that 3% flat, put them on a sliding scale, and that old rate would have been around 93,000. New rate was 32,000. So just by putting in that work and investing in the things that were needed, they saved themselves $60,000 on just one project. And that's where, again, working with somebody as a trusted advisor and professional that can help you take those steps. And if you're willing to put in the work to be able to do it, you're going to be able to have the similar type of results. And this is just one of many examples I could have used to get there. All right, so what I've talked about is basically an underwriting side, what it takes to get the capacity initially and increase capacity. So let's say that we are working with somebody and they say, okay, look, I'm willing to put in the work, I want to get there, but how do I get to a point where I can find these projects? What are the best ways to find these things to bid? Because, again, a lot of contractors might be good at a certain trade or something they want to do, but maybe they're working more private jobs or they're working residential and they want to do more commercial. Where are you finding these? Here are the two things that I can say that we've noticed that our successful contractors have done more than others. First, and it may seem obvious to some, but if they're not using a plan room already, having something like Construct Connect, sometimes referred to as I Square Foot, Quest CDN, Dodge, you'll see geographically some of these will be better than others depending on which systems are used by more of the general contractors or the municipalities that they work for. So it's kind of territory specific, and we can help you with our experience if you have any questions on which is better for this place or this place. But those three are probably the three most common ones that are used, and this is where contractors are going to be able to go in and see what's going out to bid. What are the engineers' estimates? What should I expect for the timelines? What are the specific parts of this contract that I need to consider? Another thing that's really great about these plan rooms is if you're trying to be competitive and you're trying to figure out where you need to be with your bids, you can also see what others are pulling plans and what they're bidding on these projects. And some of the more successful ones will start to create basically a portfolio of like, hey, this is where others have been bidding on these different projects. So when you go bid this next one, you say, okay, let me look at the history of what other people have done. I have a pretty good idea of what this contractor or this contractor that I'm competing with might be at. Here's where my bid needs to be. And so plan rooms are really important, and we'd be happy to help walk through any of those and our experience of those if people have questions on them. Another way that some people almost exclusively work would just be networking. So going into the city engineer's office saying, hey, where do I go find these bids? What's bidding? What's the best way for me to get in front of the people who make these decisions? We have a few clients specifically that they've built such good relationships with these city engineers that they'll get a heads up before the project even will go out to a plan room. And sometimes, depending on the size, not that it's the right thing to do, but I have seen where some engineers will just say, hey, we want you to do this project. Give us your bid, and as long as it's where we think it's going to be, we're just going to go ahead and move forward because they've had so much success with that contractor and engineer relationship. Again, it's relationship business just as much as it is for what we do every day. The DNR can be a really good resource for finding these projects as well. There's a lot of public bidding that happens through the DNR. And then other ones that we've seen success with are just building really great relationships with these engineering firms that are putting these things out for the municipalities, the general contractors. You can become a preferred subcontractor by filling out an application, having your business on their radar. But having a higher bid capacity will really improve your ability to become a preferred subcontractor, because that's one of the questions most are going to ask. What's your bid capacity? What's your bid rate? Because they want to know if we give you this option to bid it, that we're not going to run into an issue with you not being able to be competitive, and it's just kind of a waste of our time. So those are the things that we've seen, most of our successful contractors do to find projects. And I definitely went way over time. I did not realize how fast it went. So with that, do we have any questions?
I actually do have a question.
Okay.
I have a couple.
Okay.
And thank you for all of this. This was so helpful. When a contractor is submitting for a bond and let's say they do get denied, is there like, for example, what Equifax is for credit, does that exist in this bond market? Like,
Yes.
would other carriers or sureties be able to see how many times they've been denied and why? Like, does it hurt them?
Yeah. So they'll tell you what the reason is. They're not going to tell you specifically the number, because
Okay.
every carrier has their own system. So you have 3 different credit bureaus that pull, but they have different models, and some use one model, some use a different one. So they're not going to tell you specifically the numbers. They say it would be based on credit or experience. As far as like a submission, like you would see the denials that are on there, I'm not aware of anything that goes through and says there's not like you can't just log in like you can for losses on claims, right? Like they've been denied. But there's typically the question, have you ever been denied for surety before? And they want to see if you're asking or answering accurately.
Okay. Grant asked if you can help contractors in Texas.
Oh, yeah. We are
Yeah.
licensed in all 50 states
Perfect.
and DC. Last year we did, I want to say it was 42 different states in DC. Certain states just have more surety than others. So it's just, but yeah, we can work in any state.
Um, my next question, as far as for a contractor to get a letter of bondability,
Yes.
do they have to go through this entire process? Like this needs to be prepared even for that step?
So it depends on the size of the contract. So if you have somebody that's $1 million or less for a project, we can typically get them through a credit-based approval rather quickly, typically same day, and then we'll be able to provide that letter of bondability. So it just allows them to say, hey, I don't have a specific project, but I know that I'm at least pre-qualified up to this. The little asterisk I would add to that is it doesn't mean that they're pre-approved for it. So with our program that we put together, we're trying to provide you with an indication on what capacity is, but we still want to make sure that specific trades are being followed, meaning I don't want a concrete contractor bidding an electrical job. We also want to look at the contract and to make sure that we understand what the liquidated damages are and the maintenance period, meaning if the project is, say, a tight window where it's, let's say it's a school parking lot and you only have the summer to complete it, and it's a place that typically gets a lot of rain. Well, if the liquidated damages are, say, $5,000 a day and you only have 58 days to complete it, we want to make sure that we're thinking through that before we say yes to the actual bid bond, which if the bid bonds are free, by the way, we provide those free of charge. The only time that they would pay that percentage is if they actually are awarded the project and have to pay for the performance and payment bond. They typically go hand in hand. There are some outliers where a performance bond might be required or payment, and not the other, but typically they're the same thing. But we want to look at those things to help. Again, it's mostly just to protect the contractor for things that they might not know. A maintenance period is essentially a warranty. Most jobs will have a standard 1 to 2 year maintenance period. Certain states, Iowa being one of those, we're seeing almost exclusively now, we're seeing 4-year maintenance periods. So there's a 4-year warranty on it. There's a slightly additional cost to anything over 2 years. And again, that's just it's a matter of making sure the contractor's aware of it, because if they haven't run into it before, they might not know what that means.
Mm-hmm. Super interesting. Yeah, that's great information. And so how often do you suggest, and I think you already touched on this, but as far as these contractors reviewing their I guess their capacity for a bond, like I obviously I'm in insurance,
Right.
so I think highly of what we do, but I like there's a contractor that is needing bonds often and large ones. I would imagine that their person that works on their sureties are sitting up there with their banker, with their attorney. Like they should be meeting that often, right?
So they don't need to technically meet, and it just depends on the contractor and what their goals are. So in the example that I used, they said, look, we know that we're new and we know that we have to go through the process of building this up, but we want to get there as quickly as possible. Please tell us what to do. In that situation, we met quarterly to go over everything to make
Okay.
sure. And then once we got into the kind of the rhythm of it, it was pretty simple. Like they knew what was expected, they knew what to do. And as they continued to become more profitable and to increase checking all the boxes, it became pretty easy. So we can do it rather quickly. In that situation, we went from less than $1 million up to 3/6 in less than well, it's probably 2 years actually, which is huge. Some contractors will say, I only do 2 or 3 a year, and just reviewing it annually is good for me, and we're fine with that. Others will say, I only need it once in a blue moon, and if it's never going to be more than $1 million, so they probably don't ever have to
Right.
really do it, because if as long as their credit stays good, almost every carrier does a flat 3% rate, so you're not going to have a difference in rate. It's just a matter of, at that point, how quickly can you get the bond. I think that's another thing that really makes us unique is, the name Zip's intentional. We constantly get complimented the fact that we're just quick, because bonds always seem to happen last minute. And that's okay. We provide it. Thankfully, electronic seals are more and more popular, so we can do those rather quickly. We're subscribed to all the major platforms that require you to submit it electronically. But worst case scenario, we're going to overnight it to you if it needs to be, a wet signature and raised seal.
Awesome. Well, thank you, Zach. This was so
Yeah.
informative. Thank you so much for your time and for, educating all of us. This is going to be available on our website, for, contractors to watch when they can't sleep.
Yeah. Yeah.
Hopefully, it'll be answering the questions that they have. So we really appreciate your time and for being with us. And tell everybody where can they find you?
Yeah, so we're at zipbonds.com. That's where you're gonna find all of our information. The easiest way is just to go to our website. It'll give you our email, phone number, and everything. You can find me on LinkedIn. I'm Zach Mefford. But again, super thankful for the time. This is a lot of fun, and I'm just really thankful for agents like you that see the value in trying to have somebody that have multiple options and working that. I love working with agents. I love providing this. So thanks again for having me. This is a lot of fun.
Yeah, thank you. All right, everyone. Thank you for logging on. Have a good day.
Bye.
Bye-bye.